All right, we're back in overtime. Stocks rebounding to start off the week of trading with all three major indices coming off a losing week. Our next guest says it is still time to remain cautious. Joining me now, Post 9, Richard Saperstein of Treasury Partners, one of the top-rated financial advisors in this country. Are you still Mr. Negative? Nice to see you. Welcome back.
Thanks for the intro.
Okay, but are you? I mean, you've been really negative.
Yeah. So, look, we look at this as a pivot rally where 22 was fears of inflation and the reaction function of the Fed. Now this year, that's past us, and we have a rally going on, but it doesn't really take into account that we're going to have a business cycle. And the business cycle is being indicated by, look at M2 is negative, profit margins are down 150 basis points. There's four leading indicators. Three of them are pointing to slowdown. Profits are down, so we expect the business cycle to occur in 23, leading to lower EPS and a weak stock market.
So you are really almost identically positioned, at least how you're thinking about this market, to Mike Wilson at Morgan Stanley, who says almost the exact same thing. Don't believe the hype. None of this is based on fundamentals, not this being the rally that we've had to start the year. It's been positioning. It's been short covering. Everything is going to happen, as we said. It's just maybe pushed off a little bit more than people thought, including ourselves.
Agreed. And I think if we take a longer-term view, we have the ability to opt in or opt out. So the market was up 100% for the 3 years ending DEAS 21. Last year was down 20. January, it's up another 8. So there's a lot of volatility. As you know, last year, we basically reduced equity exposure in client accounts, 5 to 10% across the board, and then we added municipals. We talked about that in October.
You still like those?
Yeah, but the window closed on what we did. We were able to lock in yields of 4.5% tax-free for 8 to 10 years. So that's over. Now we have to focus on what to do going forward. And we're still not comfortable with bringing on more equity exposure.
So you're still sitting on a pile of cash, which I think the last time you were here said was the most you've ever had.
Yeah, so we deployed the cash across the board into municipals. In strategies that we run, we still have an elevated level of cash. We're comfortable with it.
What gets you back into stocks?
Well, I think there's a couple of things we have to look for. First of all, the tightening cycle won't end until the Fed funds rate is above the inflation rate. So we're still about 150 basis points away from that.
You think they're going to go 150 basis points more?
No, I think inflation will continue to come down.
Okay.
And I think
at some point they're going to meet.
Yeah.
Right?
And that would be an indication that the Fed is at the terminal rate. So figure another 50 basis points on funds, okay? But I think the other thing we have to consider is the business cycle. And we talk about hard, soft landing, real rate of return. The guy in the street doesn't care about that. The guy in the street who wants to expand his business had a loan, let's say 2 years ago, the cost of capital was Fed funds plus 300 basis points, or 3.5%. Today, it's Fed funds plus 500 basis points, or 10%. So that grinds the economy to a halt over time. That's what we're seeing, and the data suggests we're going to see a business cycle.
What about, the consumer and the strength of the labor market would suggest that there's a longer runway to that cycle than people like you want to suggest there is.
Agreed. There is definitely strength in the labor market. You still have, a lot of optimism, and obviously it's not reflected in the data. So the market's moving, data's going another way.
Okay, so here's what I sort of see as a disconnect between at least part of your positioning and your perspective. Microsoft. You love that stock. You say it's your top pick for 2023.
Yeah.
In an area that has a lot of skepticism around it that doesn't seem to fit with your point of view on the overall market. How?
Okay, so we're long-term holders of Apple, Microsoft, and Google. All right. Microsoft has great advantages because you have the cloud, okay, which has 70% gross margins. They have 23% of the cloud business, which is they're behind Amazon, which has 32% of cloud. Software, which is a recurring revenue business, and gaming. So when you look at Microsoft, $60 billion of free cash flow on a $2 trillion company. So it's a roughly 3% free cash flow yield on the company. Company's going to continue growing with high gross margins, great product penetration, excellent CEO, and it is our number one stock for the year.
Aren't you making the case for most of large cap tech?
Yeah.
Even as you hate on the market?
Yeah, so there's the market call, but we still are fully invested. Our clients still have 35 to 50% of their portfolio in equities. So it's not like we're out of the market. We just scaled back our positioning and added munis at tremendous rates last year.
But you're also, in a sense, making the case that if you are putting your money into the stock market, go towards quality. And these are the areas that you want to look, which suggests that, do you think that the tech move of this year is justified, for lack of a better word?
The tech move in high cash flow companies, yes, but there's a tremendous amount of companies that are still negative cash flow, and they had tremendous moves this year. So last year, if you take the 10 stocks with the greatest decline in the S&P, down 40% on average, are up 30% this year, but 7 out of 10 of them have negative earnings revisions. So this is a pivot rally, which we're not really participating in. So what do? We're basically looking for high cash flow. That's basically, you have high cash flow tech stocks, oil sector, and then we have a deglobalization fleet.
So you're not deterred by energy's underperformance to start this year?
No, not at all. Energy is, let's call it 11% of the S&P's profits, but only 6% of market cap. The SPR releases are over. Asia's going to pick up with the China reopening. Demand's going to increase. Our scenario is not that oil is going anywhere outside of 70, 80 bucks a barrel, and you have free cash flows anywhere from 10 to 20%, which is an amazing return opportunity in owning oil stocks.
So let me ask you lastly, and then I got to go. So with the mountain of cash you're sitting on, when you the part you haven't put into munis and other parts of credit, when you do deploy it into equities, what's the first place you're going?
It depends on where we are in the cycle and what's come down. But I think we have to look at the market earnings at 220 estimate this year. We don't see it happening. And stocks are pretty vulnerable down to 3,600. At that point, we'll reevaluate.
3,600. Okay. Well, we'll see. It's good to talk to you.
Likewise.
All right. That's Richard Saperstein joining us right here at Post 9. It's time for a CNBC News update now with Bertha Coombs. Hi, Bertha.